Advanced Audits and Assurance, Chapter 8, Audit Evidence. Contents: 1. Audit Testing. 2. Audit Documentation, ISA 230. 3. Related Parties, ISA 550. 4. Written Representations, ISA 580. 5. Using the work of an auditor's expert, ISA 620. 6. The external auditor's reliance on the work of the internal auditor, ISA 610. 7. The audit of accounting estimates, ISA 540. 8. The audit of specific areas of the financial statement. 9. Transaction cycles. 10. Chapter review. Introduction. Competencies. Legal, regulatory, and ethical issues. Identify and make judgments upon when it may be appropriate to refer to a matter. Identify and make judgments upon when it may be appropriate to refer a matter to a more senior colleague or for third-party advice or consultation. Accepting engagement and managing assignments. Analyze and evaluate the extent to which assurance and audit functions within an entity can be used or relied upon. Planning and undertaking work. Analyze and evaluate the situations when third-party expertise may be required. Evaluate and apply analytical procedures that may be used to plan an audit or assurance engagement. Reliance on internal audit specialists and the work of other auditors. Use of client-generated data, information, and reports. Test of controls, substantive procedures, including analytical procedures. Visits to locations, branches, and departments. Exam context. In this comprehensive chapter, students will study much of what is required during the field work stage of an audit, whilst a number of ISAs are revisited from earlier studies. Students will now be exposed to the full cross-section of ISAs relevant to performing an audit, all of which are examinable at this level. The chapter also incorporates specific guidance on testing the various transaction cycles, such as revenue or receivables and purchases or payables. By the end of this chapter, students will be able to 1. Explain the fundamental requirements of audit testing in the context of ISAs 500, 520, 530, and 230. 2. Describe the requirements of a number of other fieldwork-driven standards, including ISAs 501, 540, 580, 610, and 620. 3. Summarize the audit approach relevant to a number of key IASs and IFRSs. 4. Explain how to audit the various transaction cycles, such as revenue or receivables and purchases or payables. Subtopic 1. Audit Testing. Section 1.1. Gathering Audit Evidence. The outcome of an audit is a report, which usually expresses an opinion. The content of the report and the auditor's opinion may subsequently be challenged. If this happens, the auditor must be able to justify that he has written. If this happens, the auditor must be able to justify what he has written. In other words, the report and opinion must be supportable by the auditor if challenged. If challenged, the auditor will therefore collect evidence on which to base the report and opinion. Definition: Audit evidence. This is any information used by the auditor to arrive at the opinion on which his report is based. It includes information in the accounting records and other information. The auditor carries out procedures known as audit tests in order to create this evidence. This test could be test of controls and/or test of details, that is, test of transactions and balances. It is unlikely that the auditor's test will be applied to all the transactions that have been undertaken by the entity during the financial period under audit. The audit evidence will typically be drawn from a sample of transactions. Definition: Audit sampling. This is the application of audit procedures to less than 100% of the population of transactions and balances, such that all units have a chance of selection. Again, this is revised later in this section. Analytical procedures are also carried out, but not typically on a sample basis. These are revised later in this section. Analytical procedures, together with test of details, are referred to as substantive procedures. The test, the evidence from the test, and the conclusions that have been drawn must all be documented in the audit files. Section 1.2. ISA 500 and the financial statement assertions. ISA 500 audit evidence set out the objective of the auditor has been to design and perform audit procedures in such a way as to enable him to 1. Obtain sufficient appropriate audit evidence. 2. In order to be able to draw reasonable conclusions. 3. On which to base his audit opinion. Following on from this, the auditor is required by ISA 500 to design and perform appropriate audit procedures for the purpose of obtaining sufficient appropriate audit evidence. Other requirements of ISA 500 are as follows. 1. Consider the relevance and reliability of the information to be used as audit evidence. 2. If information to be used as audit evidence has been prepared using the work of a management expert, evaluate the competence, capability, and objectivity of that expert, obtain an understanding of the expert's work, and evaluate the appropriateness of his reports as audit evidence. 3. When using information produced by the entity, evaluate whether the information is sufficiently reliable, that is, accurate, complete, precise, and detailed. 4. Use effective means of selecting items for testing, covered in detail later in this chapter under ISA 530, Audit Sampling. 5. If audit evidence from one source is inconsistent with that obtained from another source, or the auditor has doubts over the reliability of evidence, consider what additional audit procedures are needed and the effect on any other aspect of the audit. Use of an expert by management. When assessing the objectivity of an expert employed by management, issues for the auditor to consider would include whether the expert has a financial interest in the audit client, for example, a shareholding. The expert has a personal relationship with a senior manager in the audit client. The fee paid for the expert services was a fair commercial price. When assessing whether the work of management experts provides sufficient and appropriate evidence for audit purposes, 1. The auditor should review the terms on which the expert was engaged by the audit client, such as the objective and scope of the expert work and whether the expert was notified that his work may be relied on by the auditor. 2. The auditor should obviously study the content of the expert report and the conclusion that the expert reached. Any assumptions used by the expert may be significant. For example, in making an asset valuation, and the auditor should compare those assumptions with his own understanding of the audit client's business. 3. The auditor may also need to check the methods used by the expert. For example, for the valuation of investment property, the method of valuation used should be consistent with the requirements of IAS 40. 4. If the expert has been used to provide a valuation, the date of the valuation should be close to the end of the financial year of the audit client, so that it is up to date and current. There may be additional evidence that the auditor could obtain to confirm the evidence provided by the expert. For example, if a property valuation expert has been used by the audit client to value a number of properties, the auditor may be able to obtain some additional evidence of the reliability of the valuation in a number of ways. 1. By inspecting some of the properties to assess their conditions. 2. By checking the cost of similar assets acquired by the audit client during the financial year. 3. For assets acquired during the year, by comparing their cost with the end of year valuation, unless there has been a large rise or fall in property value during the year. Current valuation should be fairly close to original cost. 4. By checking events after the reporting period, if any of the properties have been sold since the end of the year, their sale value should be compared with their end of year valuation. They ought to be similar amounts. 5. By obtaining representation from management that the key assumptions used in arriving at estimated value are reasonable. 6. Use of fair value accounting may require more frequent use of experts by the auditor. Sufficient and appropriate audit evidence. Definition: sufficient and appropriate. Sufficient relates to the quantity of evidence. There must be enough audit evidence to support the auditor's conclusion or opinion. Appropriate relates to the quality, that is, relevance and reliability of the evidence. The auditor will need to exercise his professional judgment on both of these aspects in deciding whether there is enough evidence to support a conclusion and assessing the quality of each item of evidence. When is there enough evidence to support a conclusion? What is the quality of a given piece of evidence? And is this sufficient to justify the audit opinion? The two characteristics of quantity and quality are also interrelated. An auditor may be able to reach a justifiable conclusion based on a smaller quantity of high-quality evidence. However, a larger quantity of lower-quality evidence may be required to reach a justifiable conclusion. The reliability of audit evidence. There are a number of general principles set out in ISA 500 to assist the auditor in assessing the reliability of audit evidence. This can be summarized as follows. 1. Audit evidence is more reliable when it is obtained from independent sources outside the entity under audit. As specified above, ISA 500 requires that the auditor should be satisfied as to the accuracy and reliability of any internal evidence used in reaching a conclusion. But note that internally generated audit evidence is more reliable when the related controls are effective. Audit evidence obtained directly by the auditor is more reliable than audit evidence obtained indirectly or by inference. For example, observation of the operation of a control by the auditor is more reliable than inquiry about the operation of that control. Audit evidence is more reliable when it exists in documentary form. This could be paper, electronic, or other medium. For example, a written record of a meeting made at a time is more reliable than a subsequent oral representation of the matters discussed. Audit evidence provided by original documents is more reliable than audit evidence provided by photocopies or documents that have been filmed or otherwise transformed into an electronic form. This is because the reliability of those other forms may depend on the control over their preparation and maintenance. Procedures for generating audit evidence. A number of audit testing procedures are available to the auditor as a means of generating audit evidence. 1. More than one procedure may be used in collecting evidence in a particular area. 2. Not all procedures may be appropriate to a given objective of the audit. The auditor should select the most appropriate procedures in each situation. There are 7 main testing procedures for gathering audit evidence. 1. Inspection. 2. Observation. 3. Inquiry. 4. External confirmation. 5. Recalculation. 6. Reperformance. 7. Analytical procedures. The table below explains these 7 main procedures and give examples of how they are used and applied. Procedures and explanation or application. Inspection, looking at an item. The explanation or application is 1. Of tangible assets. 2. Of entries in accounting records. 3. Of documents, e.g. invoices. Observation procedure. Application 1. Watching a procedure, e.g. physical inventory count, distribution of wages, opening of mail. 2. Limited to the point in time where the observation takes place. 3. The person performing the procedure may act differently when being observed. Inquiry procedure. 1. Seeking information from knowledgeable persons inside or outside the entity. 2. Evaluating responses to those inquiries. And 3. Corroborating those responses with other audit evidence. External confirmation procedure. A specific type of inquiry seeking confirmation from a third party, e.g. a bank or trade receivable. This is specifically covered by ISA 505 external confirmations. Recalculation procedure. Checking the mathematical accuracy of documents or records, e.g. adding up the list of year-end trade receivables. Reperformance procedure. Independently carrying out procedures or controls which were originally performed by the client, e.g. reperforming the aging of year-end trade receivables. Analytical procedures. 1. Evaluating and comparing financial or non-financial data for plausible relationships and investigating unexpected fluctuations. For example, comparing last year's gross profit percentage to this year's and ensuring any change is in line with expectations. The financial statement assertion. Modern auditing theory takes the view that the financial statements are made up of a number of assertions or representations. The auditor should therefore generate evidence designed to reach a conclusion about each of these assertions. The major assertions contained in a set of financial statements are as follows. 1. Completeness. There are no unrecorded assets, liabilities, equity, interest, transactions, or events, or any undisclosed items. 2. Occurrence. Transactions and events recorded and disclosed in the financial statements took place during the accounting period and relate to the entity. 3. Accuracy. Transactions or events have been recorded at the proper amount and disclosed properly. 4. Classification and understandability. Information is appropriately presented and described, and the disclosures are clear. 5. Valuation and allocation. Assets, liabilities, and equity interest are included at appropriate amounts, and any resulting valuation or allocation adjustments are appropriately recorded. 6. Rights and obligation. The entity holds or controls the right to disclose assets, and disclosed liabilities are those of the entity. Existence. That's number 7. Existence. Assets, liability, and equity interest exist. 8. Cutoff. Transactions and events have been recorded in the correct period. 9. Classification. Transactions and events have been recorded in the proper account. The auditor should therefore generate evidence designed to reach a conclusion on the reliability of each of these assertions. Section 1.3. Directional testing. Directional testing is an audit approach developed in the 1980s to provide a framework for the conduct of an audit. Directional testing has a number of advantages. The main advantages are that it helps the auditor to clarify the audit objectives. It focuses the audit work on areas of high audit risk. It links together the results of audit tests. Directional testing has its foundation in the fundamental principle of double entry bookkeeping, whereby for every debit entry there is a credit entry. If the trial balance balances but a debit or a credit entry is misstated, there must be a second misstatement somewhere in the trial balance figures. Example: if non-current assets are overstated by 2 million, but the trial balance balances, then one of the following errors must have happened to explain how the situation has arisen. 1. Possibility 1. Another asset is understated by 2 million. Possibility 2. Liabilities are overstated by 2 million. Possibility 3. Income is overstated by 2 million. Possibility 4. Expenditure is understated by 2 million. Possibility 5. a combination of any as all possibility 1 to 4 has occurred, amounting to 2 million. The nature of directional testing. The following conclusions follow on from the points raised in the above example. 1. By testing debit balances in the client's accounting system directly for overstatement, total credit balances will also be tested indirectly for overstatement. By testing credit balances directly for understatement, total debit balances will also be tested indirectly for understatement. Directional testing is therefore based on the following approach to the audit. 1. If all asset balances and expenses for the year, that is debit, are tested directly for overstatement, and 2. All liability balances and income for the year, that is credit, are tested directly for understatement. 3. Then, misstatement in the opposite direction, overstatement of credit balances and understatement of debit balances will be tested indirectly. The main focus of directional testing is therefore 1. Test debit for overstatement, and 2. Test credit for understatement. This is because in the statement of financial position, assets are more likely to be overstated and liabilities are more likely to be understated. A misappropriation or fraud will often result in an overstatement of an asset or expense. For example, the theft of cash may be hidden fraudulently by writing it off by means of the ledger entry, credit cash and debit expense. Testing for overstatement of debit balances. A test for overstatement starts with the monetary amount recorded in the financial statement. The direction of testing is then backward to its source. Such tests seek to confirm existence. For example, in testing purchases for overstatement, balances in a financial statement will be traced back to signed goods received notes as evidence that the goods were received. Testing for understatement of credit balances. A test of understatement starts as the source and traces transactions forward to the financial statement. These tests are aimed at ensuring the completeness and accuracy of recorded transactions and balances. For example, in testing sales for understatement, signed dispatch notes are traced through to sales in the financial statement to check that the sale was recorded. Example, testing trade receivable balances for overstatement or existence. A starting point for testing will be the entity's list of receivable balances, the list of customers owing money as at the end of the reporting period. The auditor wants to check that these receivables do in fact exist. One way of doing this is to write directly to customers on the list, asking them to confirm the amount that they owe the entity. Alternatively, if the auditor is checking documentation within the client's entity, he can take a sample of receivables from the list of balances and trace their existence back through the accounting records from receivable ledger to sales table to invoice. Testing trade payable balances for understatement or completeness. To test payables for completeness, there is no point in taking as a starting point the entity's list of payables balances, because this may not be complete and the auditor is testing for completeness. Instead, the auditor may write to regular suppliers who might possibly be year-end payables based on the total amount of purchases from the supplier during the year. If the supplier is not on the list of trade payables or is listed as a payable for only a small amount, the auditor can ask the supplier to confirm this fact. This is often referred to as testing the reciprocal population. Alternatively, if the auditor is checking documentation with the client entity, he may take as a starting point a sample of documents indicating that goods have been purchased or received, such as a sample of goods received notes, and then trace the purchase through the system from purchase invoice to purchase daybook, payables daybook to payables ledger. Sampling. ISA 530. ISA 530 audit sampling states that the objective of audit sampling is to give auditor a reasonable basis for his conclusion about the population from which the sample is drawn. The auditor is not interested in the results from the sample itself. He is only interested in it as a basis for reaching a conclusion about the whole population on that test. However, there is always a risk that the auditor will reach a different conclusion based on the sample than he would have reached had he tested the entire population. This is referred to as sampling risk. To reduce this risk, and therefore detection risk, to reduce this risk to a minimum, the sample must be designed in such a way as to be representative of the whole population. In setting his sample size, the auditor will need to take into account the expected misstatement or rate of deviation, that is, for test of controls. This assessment will be based on his experience in this area from previous audits and on any related areas on the current audit. The result of the sample will be compared to tolerable misstatement or rate of deviation. Definition: tolerable misstatement. Tolerable misstatement is a monetary amount set by the auditor in order to address the risk that the total of individually immaterial misstatements may cause the financial statement to be materially misstated. It is the application of performance materiality to a particular sampling procedure. A misstatement above tolerable misstatement will therefore be considered material. Definition: tolerable rate of deviation. Following on from the above, the tolerable rate of deviation is a rate of deviation from prescribed control procedures which the auditor is prepared to accept and still be able to conclude that the financial statements are materially correct. Section 1.5 Analytical Procedures, ISA 520. It is important to remember two key points when dealing with analytical procedures. 1. The evidence gathered is supplementary to evidence gained from other audit testing procedures. 2. The basic objective of analytical procedure is to allow the auditor to assess whether the reported figures make sense in the context of known business facts. If the analysis indicates that there are some figures or ratios that do not make sense, that is, there are some anomalies, these require further investigation by the auditor. The nature and purpose of analytical procedures. Analytical procedures are defined by ISA 520 as evaluation of financial information through analysis of plausible relationships among both financial and non-financial data. The analysis usually consider both comparisons and relationships. Financial information in the draft financial statements is often compared with a benchmark. For example, ratios, trends, and relationships for the current financial year are compared with prior periods, that is historical data, budget and forecast, future-oriented data, predictive estimates, industry averages. Typically, relationships are used in analytical procedure to analyze 1. Items of financial information that are expected to adhere to a predicted pattern, such as gross profit margin. Any significant change in this margin compared with the previous years should be investigated. 2. Relationships between financial and non-financial information that might be predictable, such as payroll cost per employee. Using analytical procedure in the audit process. Analytical procedure can be used at 3 stages in the audit process. 1. They must be used in planning the nature, timing, and extent of other audit procedures. 2. They may be used as a substantive procedure when their use is more effective or efficient than detailed substantive test of transactions and balances. 3. They may be used at the overall review stage to allow the auditor to conclude whether the financial statements as a whole are consistent with his knowledge of the business. Analytical procedures are not concerned only with the analysis of trends. The auditor must use analytical procedures to reach a conclusion about the financial statement. It is not sufficient for the auditor to calculate and summarize ratios for this year and previous years and to record the trends over time. Analytical procedures are also concerned with the investigation of changes away from expected trends and the corroboration of explanations as to why these changes have happened when they were not expected. Example: analytical procedures. An auditor has calculated the gross profit percentage for a client company. This year, the gross profit is 25% of sale, but last year it was 20%. The auditor is not aware of any change in the nature of the client's business, and he had been expecting the gross profit percentage to remain constant at about 20%. The financial director of the client company gives the explanation that purchase prices have fallen in the past year or so relative to sales prices. The auditor should accept this explanation as a proper explanation without finding evidence to corroborate it. It is possible that purchase prices are falling in relation to sales prices. However, a possibility that the auditor needs to eliminate is that purchase prices have not fallen, but the client company have included an excessively high figure for closing inventory in the statement of financial position in order to increase profit. A closer investigation of purchase prices should confirm the finance director's explanation or leave the auditor with a suspicion that there is something unusual in the financial statement and that a proper explanation has yet to be found. The extent of use of analytical procedures. Several factors should determine the extent to which the auditor can use analytical procedure as a form of audit evidence. ISA 520 requires the auditor to 1. Determine the suitability of particular substantive analytical procedures for given assertions. That is, how effective they will be in dictating a particular type of material misstatement. This usually depends on the closeness of relationship between items of data. Analytical procedures are more appropriate when relationships are plausible and predictable. For example, there is normally a close relationship between sales commission and sales revenue, whereas the relationship between administration cost and sales revenue is less close and so less predictable. 2. Develop an expectation of recorded amounts or ratios and evaluate whether that expectation is sufficiently precise to identify a misstatement. How effectively this can be done depends on factors such as the accuracy with which amounts can be predicted, the extent to which information can be disaggregated, e.g., sales split out by product line, the availability of information. 3. Evaluate the reliability of the data from which the expectation has been developed. If data is unreliable, then it will be of little use. The auditor should consider such factors as the source of the information, comparability of the information available, the nature and relevance of the information available, controls over the preparation of the data. 4. Determine what level of difference from expected amounts is acceptable without further investigation. Investigation of fluctuation. Fluctuations are significant changes in a financial ratio or a trend compared with previous financial years. When carrying out analytical procedures, the auditor is primarily concerned with identifying the unexpected and reasons to explain why anything unexpected has happened. If the unexpected has occurred and cannot be explained, further investigation by the auditor will be necessary. Trends or deviations that do not fit with known business facts should be discussed with client, staff, and explanation must be obtained. It is often more useful to the auditor to discuss matter with several of the client staff who are responsible for non-financial as well as financial operations. Explanation must not be accepted at face value but should be corroborated by other audit evidence or the auditor's knowledge of the client and the industry in which it operates. Therefore, if the auditor finds fluctuations or relationships which are inconsistent with other information or unacceptable level of differences from expected amounts, then ISA 520 requires him to make inquiries of management and verify management's responses and perform other audit procedures as necessary.